if we reflect on February, equity markets were still relatively robust, and certainly from a domestic front, we've been through earnings season, so most of the companies that would report at this time of year have reported and updated the market, and that starts to pull through some company-specific positives and negatives that you see in markets. Large cap businesses were the standouts, so the big banks performed well, the resources companies performed well on the back of stronger commodity prices that they're receiving in certain parts, and generally the larger businesses did better than the smaller businesses, so those that have got a few more levers in their control that were able to perform well for the period. Resources for the Australian economy are up like 60% for the last 12 months. So that's on some of these geopolitical tensions, it's on some of these supply tensions, and I suppose on some of the second and third order effects of this AI trend as well, that the data centers and the chips and all require many of these precious commodities and metals that are being able to be extracted from some of the mines either here or some of the businesses that have mines around the world. As we got to the end of February and into the start of March, we saw the geopolitical issues escalate through the Middle East. Clearly there's some challenging matters that people need to deal with that are affected by those. From a markets perspective, thinking about it from an investment side of things, inflation's probably the first one that comes to mind that people need to be cognizant of, and that's largely related to energy prices. The shipping lanes that through the Middle East there account for quite a significant amount of oil and other energy traffic, fertilizer traffic as well. Much of that flows through to Asia, so there's a flow-on effect pretty quickly that mechanism will pass through to inflation in the supply chain in many Asian countries. So that may have a sort of a second or third order flow-on effect to consumption and other parts of the world as that gets pushed through into other parts of the global economy that we're impacted by. And then clearly there's the uncertainty of how long this goes for, and so that's something that we will need to continue to monitor. You know, at this stage, it's been relatively well contained in terms of the impact on markets. The earnings outlook for many businesses are largely not impacted by this sort of escalation. Where it is, there's probably a bit of a swings and roundabouts, to use a term, where you might have some beneficiaries from higher oil and energy prices that offset some of the detrimental impacts from higher inflation and other cost inputs as well. So while these headlines and more than headlines clearly impact markets, now is a better time than ever to think about patience with capital. Yeah, so yes, there's immediacy in terms of things that change and people react to what's been happening and trying to guess how long and how impactful. But it's where you need to be patient. Yeah, often the first move may not be the worst of it. It may not be as bad as some expect in some cases either. And so taking a patient view, but also the fundamental diversification message, you know, making sure that you don't have all your eggs in one basket, making sure that you do have exposure across different parts of the world, geographically, different asset classes, and that's within asset classes, so not just bonds, but also lending to businesses. It's not just domestic or global shares, it's emerging markets shares, it's having a range of different options that are within your portfolio that will hopefully ballast out any of these risks that we're confronted with regularly. The RBA is still very data driven at the moment, so inflation is clearly front of mind. We've seen that stabilise at a higher level than what is desirable for the RBA, and so they did make a move to increase rates, which is one of the first developed nations in this cycle to begin that process. Japan's a little bit different. They have been increasing rates as well, but for different reasons and different part of the cycle for what they're doing. But Australia, the RBA did make that decision that prices that they're seeing in services parts of the economy are still rising. So there's still wage pressures, there's still pressure from insurance costs, which are still flowing through. And so to try to reduce some of that inflationary risk, they did make a move to increase rates, which was expected. And it's saying a bit of a different perspective on our interest rates versus what's going on with interest rates globally. One of the big dispersions that we saw in the month, and if you look at the S&P 500, the US index as an example, the S&P 400, which is outside of the 500, it's the next layer of companies, outperformed the top 500. And the large cap companies in the S&P 500 were the ones that were starting to lag, which think of the Magnificent Seven, those that had been leading this AI boom or this AI race. There was a bit of a rotation from those, and there was a further rotation away from, so some negative outcomes from other software businesses that are seen to be potentially disrupted by this AI boom that's going on. So markets are now starting to look through just who are the winners of this likely AI boom to now, well, what are the risks in other companies and other sectors that we need to be mindful of that will be disruptive from this AI expansion that's going on.